Hello and welcome to another Commodities catch-up for the second half of CY25 as part of Bell Direct's Market Insight series. I'm Grady Wolf, Senior Market Analyst with Bell Direct. Today, I'm thrilled to once again be joined by my good friend Hedley Widdup of Lion Selection Group to discuss a commodity boom that is upon us, how he reads the gold rush, how much steam is left in the price, which commodities are on his radar for 2026, and we both predict a gold price a year from now, along with other commodity topics of discussion. I really hope you enjoy my commodity catch-up with Hedley and the last we will do for just a little while. It's been a while since we had our last catch-up. Let's talk about commodities. It's our favourite thing to do when we catch up. So talk to me about what you've seen in the market. Obviously gold, we can't ignore that. Let's start there.
Yeah, sure. Great to be talking to you again, Grady. Gold's just defying expectations, I think, for a lot of people, because 12 months ago, it seemed to have good fundamentals, but it wasn't really running. And it's gone so hard in 12 months that people sort of sit up and go, wow, what happened there? I think with gold, you've always got to take a really long-term historical perspective to it. And if you go back decades, there was a time when central banks really needed to own gold. I think we're back in an environment now where central banks need to own gold. There's all this de-dollarization and central banks are driving it, but we're coming into a period that looks more and more like there's going to be nations with conflict. And that being the case, I think those BRIC nations are thinking ahead and saying, we want to own this. And when they're like that, they're not price motivated, they're ownership motivated. So price goes up. I think there's a lot of people following that as well, and Western markets seem to have caught on.
I completely agree. It's crazy. Like geopolitical tensions, you've got everyone diversifying their reserves away from this US dollar. The US, do you reckon it's becoming less powerful in its influence on the world, or do you think Trump's really got it nailed down?
Again, with a long-term historical perspective, I think the US is losing its grip on, dare I say it, empire. The US has never wanted to think about a US empire, but they have a history which is a lot like that. And, this seems very much like Great Britain after the Second World War, starting to eke away in terms of its influence. And that probably is accelerated by the massive wedges which are in place between the US and the Chinese, the US and the Russians, and large parts of the world which are now sort of anti the US dollar. So, how that progresses, I think will surprise everybody, but I think that's probably a driver which is unavoidable.
So today it is the 21st of October. We've hit gold at 4,365 this morning when I was doing my report. What will it take for the gold price to stop, in your opinion? Like right now for me, I'm seeing the tailwinds are still there and there's a lot to love about it. ABC Bullion just down the road in Sydney, people are lining up every day to get their hands on gold. So what will it take to stop it, do you reckon?
Well, I think there's two big headlines that could probably terminate gold's run. And the first one is inflation shrinks to zero. Now, I think that's pretty improbable. There's all sorts of opinions around inflation. Yeah, it's just, correlation between commodities, strong correlations usually mean inflation. And strong correlations between commodities often happen during times of enhanced conflict. So I think this is a really difficult one to sidestep no matter what government policies are. And the second thing that would probably get in gold's way would be a massive increase in global production, because that would be supply rising to meet demand. And that, again, I think is extremely improbable. We'll see increasing production, but, you need a 50 to 100% expansion in gold production over probably 6 or 7 years to meet that. And I think that's going to be tough. So, it tends to be something which I think is a robust fundamental for gold now.
I think so as well. And also, talking about that, we've got some big names in the industry. All-in sustaining costs are still sitting around that average of about 1,800 to 2,000 per ounce. So you can't really cap costs there and in a higher input cost environment. So I think for us, we're looking at your Northern Stars. They've got just doubled their production output for their mill there. So 12 million tonnes per annum to 27 million tonnes per annum. So that's looking pretty good for them favorably. But that obviously incurs some costs and capex of 1.5 billion. But where are you seeing the opportunities in gold right now? Because a lot of these miners have run the race. We've got a hold on a lot of them. What are you looking at?
Well, if you were to compare, and I don't think price to earnings ratio is a great measure for gold miners.
It's not a good metric anymore,
their revenue line is so variable, and it comes down to gold price.
And hedging.
and there's a lot of natural variation that can come into that. So it's not like you're selling industrial products that vary very little in revenue from year to year. So to price them in that method is probably poor. But I think when people run models of these miners and compare them to the prices that the market has been prepared to pay in hot gold markets in the past, gold miners are still trading very, very close to their, call it net asset value, which is going to be a combination of discounted cash flow and a couple of other things added in. That being the case, there's daylight between that and the 2 times NAV, which they have peaked out at in previous cycles. And that was possibly when the market sought gold miners for a diversity of reasons rather than just exposure to the gold prices they do now. But they don't seem expensive, particularly when you talk about big companies that are trading on very high multiples like Commonwealth Bank or the techs out of the US. So
even ANZ's up there today.
So I think that the gold miners still, to me, look cheap on that metric. But if you start at that point and go, well, is there a cheaper entry to gold? Taking a bit of risk gets you into the developers. And they have been the ones which I think have performed most strongly in the last 12 months, probably as the market starts to realise that. That is where institutional money from around the world seems to be pouring in through capital raisings. And I think they're seeking those exposures, knowing that this is the lowest risk environment you could find for a gold developer. If they can't get into production in this environment, then they probably won't.
Probably won't. So what are some names you're looking at? I know we both just been to the Resources Rising Stars conference. For me, I think Mammoth stood out because they've got the copper and gold exposure now, Gorilla Gold as well, got a pretty good asset on their hands. I think for me in the gold space, like I don't know about you, but I look for grade, asset size, and management team is probably the biggest one for me. So those who have done it before and have proven they can do it, like your Simon Lawsons, your Bill Beaments, obviously he's not in gold, but we'll get to that later. But I think the ones who have done it before and have proven themselves, they're the ones that I kind of follow and I go, what are they up to next? What about you?
Yeah, no, I think that's a very good notion, particularly for investors that don't have sort of a relationship network across the industry to be able to judge good from bad. Go by someone's track record is a safe place to start. And those names you've mentioned that really are charging as well. I mean, they seem like they're growing their asset bases, which is the fastest way to add value to a stock that isn't producing yet. So I'll give you 2 names. First one is Saturn. This is a company which it's actually low grade, Grady. It's not high grade, which is one of the things you look for. But it's an enormous. It is, yeah.
Sat down with him at the course of the interview. We can link that into this, which is great.
An enormous ore body, very, very broad. So you can mine it really, really efficiently and low unit cost. And there is no such thing as bulk economics in gold until you look at a deposit like this. So that's why I like that. It is low grade, but you get phenomenal economics from the efficiencies there. And the second one I'd give you, and this is a growth story, is one called Sunshine, also from Resource Rising Stars. They're based in Townsville. They're operating around Charters Towers, and they've got a small high grade, so you would like that startup story. It's about 8 grams, 9 grams underground. And they're finding gold at a place nearby as well. So there seems to be a good amount of growth with that one, and I think the market is starting to look at them. I think it's one of the ones which is still challenging the radar a bit, not quite on it. So they're both in our portfolio, so I've got to give you a ding, ding, ding on that one. But all conflicts declared. Love those.
That's right. Mammoth and Gorilla are in my portfolio, so happy to be disclosing everything there. With a miner right now, or no matter the commodity, do you think it's even more essential now than ever that they have multiple assets?
I think multiple assets help because diversity in any portfolio, whether it's yours, mine, or a miner's portfolio, shields you from one-off issues and risks. So it's often a good thing. But, you've got to start somewhere and often, companies can't do that. But if you're just going through the risk profile of a subset of commodity companies or companies in the space, the ones that are multi-asset producers that have spent their CapEx and are now just in a harvest mode on their assets with longish lives in front of them are going to be the ones that present probably with the highest price you've got to pay. But at the same time, you get the lowest risk there. And the risk that you're really taking with those is commodity price, because if that goes down, then, the valuation comes out of them. But I think, multi-assets is always a great place to be. And you'll probably find that if 2 companies come together that have 1 asset each, 1 plus 1 often does make 3 in an M&A sense like that. So I think the market would support that notion as well.
Absolutely. Now let's talk about copper. We've had the gold run.
Copper, in my opinion, is even more needed than gold on a global scale for a prolonged period of time. We have this supply downside that's coming to the market, and demand is only going to keep running. We've seen this new tailwind emerge in the defense space, needing copper because of its thermal qualities, its electricity qualities, and its green energy qualities that we're seeing. And at the same time, the price really isn't reflecting it. What do you think's going on? Why is there a mismatch in spot price as opposed to this demand upside that the world is seeing?
Yeah, well, I suppose it's even used in AI, right? Which
it's nuts.
I don't use AI much, but AI is a tremendous consumer of energy.
Yeah.
There's a huge amount of copper required just to install the infrastructure
and in data centers, yeah.
Yeah. So it's like every single thing that we do drives demand for copper.
Yeah.
And
but why is the price not there?
Well, I think if you look at the price and plot that over 20 years and then see if you can plot it over 60 years, copper always tends, because it's a consumable, right? It bumps up against a price that at some level, and it tends to be a level that it stays at for quite some time, where buyers just fall out of the market. So let's go back to an old-fashioned usage of copper. If you and I had a company and we were making power lines, and so we'd make the copper lines and then we'd sell them to people, there'd be a point where we go, oh, mate, this month copper is just too expensive. We're going to have to sit back, go through our inventories, sell what we've got, and then wait for the price to come down. And I think that behaviour has been kicking in more and more with copper. Now, we've seen that paradigm change 2 times at least in the last 6 decades. And the first time was when the Japanese became enormous consumers, so that they would be producing finished product and they were buying a hell of a lot of concentrate. Second time was when China became the biggest consumer of commodities in the noughties. And that moved, call it the roof price for copper, up by about 3.5 times to not far shy of where we are now. So that big demand will, I'm certain of it, is going to produce a new paradigm in copper price in the future. But right now it's held back what people are prepared to pay. And you know, a big enough demand bubble comes down the line, like AI rubber really hitting the road, and an electrification push, that'll push it. But you know, that could be a story for the next 5 years rather than the next 2 or 3 weeks.
Yeah, I couldn't agree more. And also, like, as I said, this defense tailwind coming through, like all these defense stocks are running so hot. EOS, Drone Shield, Austal, but they will require copious amounts of copper, which is just insane because, as I said, the electrification qualities and the thermal qualities and transmission qualities of energy, it's just so needed. So, but at the same time, there's not enough high grade quality copper coming online. So where are we going to see this supply deficit made up? You've got your Develop Global, which is our buy at the moment, and their Woodlawn project, copper zinc project. They're ramping up to steady state next year. Everything's looking good on that front for us. And we've got, obviously, they've got the multiple assets, which ticks a lot of boxes for us at Develop Global. Their management side, Bill Beeman, been there, done that. He knows what he's doing. He's absolutely killing it there. So again, another tick. And they've got these assets across tier 1 jurisdictions, and they're not just one commodity. They're zinc, copper, sulfur, all of these things, and lithium as well. So I like Develop Global for copper right now. What are you liking?
I'd love to tell you that I had a couple of names that were about to pop in copper. But we've assessed a lot of things, and I mean, there's a couple which we probably like, subject to a couple of developments occurring. And everything that we've looked at, I suppose you kind of, once you model out what their development trajectory might be, you really need the copper price to stay where it is for them to remain attractive. And that's if they have a fundamental. There's a lot which are probably projects where you'd have to say there comes some growth. They need to get bigger, or they need to find higher grade, or something needs to happen in order to improve them. So the junior space for copper has been cleared out in the last 25 years, and we've just seen the tail end of that with Oz Minerals disappearing into BHP, which wasn't recently, but it's a trend which has gone on for many years. So it's a really difficult one to suggest in this space, and I'd probably have to say, if it's copper exposure that you're after, then you're probably starting to look internationally or in the realms of the producers.
Even Evolution Mining, gold, copper exposed.
You get a nice hedge there because you get copper and gold, and the effect that copper has for Evolution is that it brings down their effective all-in sustaining cost of producing gold. So it's a very, very sustainable, and they have probably one of the better projects, or two of the better projects, which sit in the the sub massive global major space, being Ernest Henry and Parks. So, those two would be great copper exposure. If all you're after is copper exposure, you're going to have to stomach some gold with that, and I don't think that's a bad thing at the moment.
I don't think it's a bad thing at the moment. And I like the fact that they've got good cash balance at Evolution, and we like that as well. They've got low all-in sustaining costs, as you mentioned, dragged down by that copper element. So there's a lot to like about Evolution. It's kind of a stable one to hold in your portfolio with both commodity prices booming. So I think as well, the big blue chip companies like your Rios, your BHPs have really capitalized on the downside of China with iron ore demand and the pricing power and negotiation issues we've had recently with BHP's iron ore sales to China. They've really capitalized early on this copper growth story, and it's really bolstering their balance sheet and their revenue potential through diversifying into green energy materials like copper. So I think that was kind of a sign of what was coming. But has the iron ore train kind of fallen off, or what do you reckon with iron ore?
Well, that's an interesting one, because for the last 25 or 30 years, the best return on investment that Rio or BHP could make is just put a little bit more train line in the Pilbara and get a little bit more iron ore out of there. Just keep expanding those businesses. And I mean, if you think of the margins in those businesses, if they were selling iron ore for $100 a ton, it's only costing them $25 a ton to get it to where it needs to be. So they've got this enormous 3 times margin on that. And that is, it's almost unnatural. It can only exist because of the monopoly in production, which they have. And, that has been quite profitable to them. Now, for them to then venture into copper and expand their production in copper, I don't think they could hope for the same return on investment without seeing a much, much higher copper price, because at the moment, margins in copper production are going to be percentages, not multiples. So that they will probably wean themselves away from that, knowing that copper is going to be the thing they need to be investing in. But it's going to be a difficult decision just looking at the finances for them, and quite brave as well. But I suppose you would say, once upon a time in BHP or Rio, someone had to be brave and commit themselves to investing in the Pilbara and building a business there for the first time.
Exactly.
And there hasn't been too many CEOs that have need to make a braver decision than that inside Rio or BHP ever since. So, they harvest away from that at some stage soon.
Absolutely. Now, talking on a broad scale for mining, what metrics do we need to keep in mind for FY26 where we can find some hidden gems? Like, obviously, input costs, capex, labour. We've got a lot of macro influence. What are you seeing?
Well, one of the things that and going back to the gold sector, just as an example here, one thing which I think underpins the fundamentals there is that there is very little sort of new production in other areas coming on. If iron ore was ramping up, if lithium was ramping up, and all those things and new projects coming on, it puts tremendous pressure on power cost, reagent cost, and labour cost. We don't see those drivers. So I think there's an environment here where costs can remain reasonably static. But if we were to see other commodities start to perform strongly, then it's going to spread this desire to be expanding and building new projects across the rest of the sector. So I think that's where we'll see cost pressure come from, and that's the thing that I'd be watching carefully there. So it's you see other commodities start to pop, start to worry about cost inflation sneaking in. Other than that, though, the ability to get power to projects, I think, is probably one as well. People are starting to now talk about how cheap oil looks like in relationship to things like gold, and it's easy to say gold is massively overvalued in relationship to oil because it's performed so strongly, but when that has been the case in the past, you've often seen people funding oil investments with gold, and we sit in a very unusual environment for that at the moment because of the movement away from oil and fossil fuels. So let's just keep an eye on that one, because I think money often gets in the way of people's best intentions, and you may very well see oil prices start to move here as speculators move in around that, and an investment in bringing more oil to market as well.
Now, M&A is a massive space right now. Do you think that we'll see enhanced consolidation in the gold space over the next year? I think what Bill Beeman said at the RRS panel that I hosted, how he said if you grab a protractor, and you did a circle around where the majors are in tier 1 jurisdiction, Western Australia, all the smaller players there who have some good land around the outskirts of these big mining projects might be taken out. What's your thoughts on that?
Yeah, I think there's 2 things that are in my mind. The first one is that for the last 10 years or more, the whole of the mining sector, but in gold in particular, a lot of the major companies have favoured production growth and acquisition over organic growth. So, you know, they have definitely grown inventories, but not so much as they need to supply their own organic growth and meet the growth projections which they're putting up for themselves. So there is a desire to acquire from that perspective. And I'd say that definitely puts a focus on some of the bigger inventories that sit proximal to existing production facilities. So I couldn't agree more on that one. The other thing which I would add is, let's just think about history again. Those gold companies are all awash with cash. Their balance sheets are strengthening every single day. And the behavior that we've often seen from gold companies in the past when they get flush with cash is not, oh, let's give this all back to our investors. It's exactly, let's buy whatever we can. I mean, you know, this fundamental, I don't think they'll be looking for change. There will definitely be a desire to become bigger. And particularly as people or the market begins to pay a higher multiple for more diversified and so-called safe companies. And that, you know, that combination to create bigger things, game the index, get access to bigger generalist investors is definitely a desire within that space, because gold has gone from something which was irrelevant in the investment market 2 years ago. All of a sudden, a gold company could become part of the portfolio of the massive generalist investors, which are going, we've got these 7 companies in the US that are all tech focused. How do we diversify away from them? Do we need an exposure? And if you could be that one company which gets that exposure from them, they'll be price agnostic. Your price will go up as a result, but you'll get their backing. So that is an enormous tantalizing prize for them, and I think that will drive M&A.
I think so as well. Now, a lot of our investors and a lot of the market are very well, you're known for your clock. Talk to me about the clock. For those who haven't watched our episodes before, give a brief explanation of the clock and where we're at. What time is it? Are we in a boom?
So the mining market is incredibly cyclical. It goes from boom to bust. And I think that's the part of this explanation which a lot of people get. They're familiar with the notion there's a mining boom, and they're familiar with the notion there's a mining bust. And back through history, these things follow each other. Boom, bust, boom, bust, boom, bust. That's the way it has always occurred. So there's no reason to think that that's ever going to change. And what it's driven by is money, liquidity, coming into the mining space or leaving again. And a lot of that is driven by speculators. So when there's a speculator which is alive and well, has a low risk appetite, and is very, very happy to pile into speculative things in the mining space, you've got a boom which is on really loud and clear. Mining booms tend to last for a while, and the thing which brings them undone is that the speculation gets too much, prices get too high, investment returns get too low, and the sentiment flips over and it becomes a bust. So we describe this using a clock, and that's because the behaviours tend to be the same at every position around that clock. Different booms, different busts, but the behaviours are always the same. So 12 o'clock midnight, let's invoke the Cinderella story here. That's when the lights came on.
Run home.
The glass slipper came off, the coach turned back into a pumpkin. That's the end of the boom. And then 6 o'clock. 6 o'clock must have been the time that Cinderella arrived at the ball. So nothing to worry about, you know, go to the bar, start dancing, let's carry on.
I love it.
And I think, our assessment of this at the moment, we said that we were at 5 o'clock, as in just before the boom would start in May this year. Where we sit now is we can see very many clear signals that liquidity is not just coming back but rushing back to our space. So we haven't updated the hand on the clock, and that's primarily because if you have it pointing straight down to 6, it's like a line ball call almost to say where it's about to start, or has it. I think we will probably call it when it gets to 7, but I think we're well on the way to that now. So to answer your question simply, we're in a boom. No, I think it's probably a bit past 6, Grady. I think we're in a boom now.
Good. Okay, so heading into 2026, obviously there's a lot to take into account on the commodities front. It's changing pretty quickly, but where are you seeing where are you bullish on? What commodities? Because I've got 3 that I know I'm bullish on, so I'll let you go first.
Yeah, okay. Well, look, I'm what is it that people say when they're putting out research? I'm constructive on all commodities at the moment. I think there's a pretty rosy future, and that ties itself to liquidity, our read of the cycle. Commodities tend to perform well through a boom. So I think most of them are pretty well set. But I think we see a massive, massive difference in the attitude towards the supercritical things. Rare earths are not going to be easy to bring to the surface. It's going to be difficult to bring new production online, but there is a hell of a lot of government will coming towards those now, and I think that's going
Especially
to massively inflate those things. Yeah, just this morning we saw headlines. I don't think it was a negotiation. I think it was just Trump going, "Let me give you a hell of a lot of money, Elbow," and he comes home with it. Yeah. So rare earths is a space which I think has got a lot of promise to it. It's hard to say that that's the iron ore that we saw in the noughties, but I think if you just say, here's a set of new governments, new jurisdictions which are moving in and wanting to become new demand players, that's very similar to the behaviour of China towards iron ore in the noughties. So I think we could probably expect a pretty robust outlook for that. Gold, I continue to think is going to be very, very strong. I think that's going to lead the way for, it's got years ahead of it, I think, in terms of this bull market. We might not see quite the gradient that we have this year, but, I think it'll be a positive gradient. And with that, it will drag silver. I don't think you're going to see a ratio which narrows where you have silver going, to a lower and lower fraction of gold price. But I think you will see silver have a similar trajectory. And silver is consumable. So that same thing I said before about copper is probably going to be true of silver, that consumer pain will probably overcome investor demand at some stage, which might put a cap on it. But I think it's going to be a fairly strong and frothy market for the next little while. So you tell me your commodities, Grady, and then I have a question for you.
Yeah, I'm liking titanium at the moment. Stock in the space is Hyperion X. I actually bought in, so disclosure, it's in my portfolio, and it's one that Bells actually recommends at the moment as well. I like titanium because of its use in this defense thematic, and that, for me, the defense thematic is kind of at the start of where the AI boom was maybe a year ago, because the governments are promising so much spend. We're actually seeing it materially turn into spend. They're signing contracts with these companies like EOS, Drone Shield, and they're contracts that are multi-year, hundreds of millions of dollars. So I don't see that kind of slowing down anytime soon. And these products, the hardwares, the softwares, all require titanium, copper, and aluminium. So those three are my kind of key commodities I'm watching over the next year, because as I said, as we talked about, copper's price is just not matching the supply downside that I see coming. Titanium as well, it's obviously a critical minerals. We've got production costs are coming down in the US for companies like Hyperion X, who have their own assets and technologies. And there is tight supply for titanium right now. So those who are operating in this space, they're looking pretty favorable on an investment front moving into 2026. Copper, we've talked about that a lot. So that's my other one. And as I said, aluminium, it's a big one for like ship hulls, armored vehicles. It's really required in this space. There's, again, not enough supply online, not enough high grade coming through. And we've got favorable price outlook as this new tailwind emerges in the defense space. So yeah, those kind of three are my three at the moment, but I'll be watching them closely over the next year.
I got a titanium bike, Grady, and it's very nice and light. It rides really nicely, and I'm thinking of buying another one. So, my personal demand for titanium is doubling in the near future.
I love it. Well, see, my earrings are titanium because I'm allergic to some metals. So I went with the titanium. So very multi-use there for titanium.
Well, you can also print with titanium. So 3D printing titanium is a thing, as opposed to that's a lot more difficult with other metals. So it's something which has this versatility in construction and use, which I think makes it a very important metal for the future too. So
it is definitely. It's in my portfolio. Okay.
I got a question for you then. Yes. So you sit within Bell's,
I do,
call it a broker hat if you like, and you observe the market very closely. I've seen you on TV shows and talking to people like David Koch, and you're well above my pay grade there in terms of access influence. And what interests me is that in your observations there, particularly what you see through the broking side of things, where do you see investors' interest sort of waning or flattening, and where do you see it really picking up? Because this goes into my read of the clock, and I'm interested in your opinion, so I can upgrade that time with the Grady input as well.
Yeah, so every week we get our top trades of the week, ETFs, equity and direct equities. So what we've seen for the last 6 months, our clients have been, the top sells of the week have been all four big banks. So CBA, ANZ, NAB, Westpac, consistently on the selling chopping block because the valuation is so high and growth is elsewhere. It's not in the earnings of the banks anymore. We've been seeing a lot of gold ETFs, so PM Gold, GOLD, NUGG, they're constantly on the top traded ETFs every week. So investors are looking still for that gold exposure, but a little bit de-risked in the form of an ETF, not so much diving into the miners. On the mining front, we're seeing developed globals up there every week. We've got Evolution's quite popular at the moment. NST, Northern Star, Newmont as well, world's biggest gold miner. You've got these ones, like the big names. They're yet to delve into the little names, but I know some of the smaller names are definitely getting some backing from bells, like Minerals 260 with Tim Goyder, chairman, Luke McFadgen as the CEO. They've got a seriously great asset at bulling, so a lot of our clients are really bullish on that. For mind the pun there. They're bullish on it. But so gold's definitely in the portfolio for a lot of our clients and a lot of exposure. And a lot of our clients are using it as a safe haven as much as it is ever before. But at the same time, it's kind of overtaking the banks as your staple safe haven in your portfolio, because every week it's the golds that are bought and the banks that are sold. So it's really interesting to see that kind of twist in dynamic and twist in investor mindset to go, yeah, you know what? Banks have had their run. I'm happy to let go and get some profits there, but I will have the gold as a staple element in my portfolio. So we're seeing that a lot. What else is there? There's a lot of the kind of staples that have run hot, your Coles, your Woolies, they're kind of been on the chopping block as well. And we're seeing investors kind of dive into those niche retailers, interestingly, the ones that have got really high margin expansion over the last year. And I think the ones that are just going to benefit from a lower interest rate environment, your REIT stocks, your Goodman Groups, your data centers, playing into that thematic of diversified exposure to the AI theme as well. So yeah, there's a lot to love about the markets. And I think whilst I am very optimistic about 2026 and FY26, I think there's still some good opportunities in the market in the small to mid cap space where valuations aren't so stretched.
Yeah. I think it's fascinating to see money starting to move out of the banks and into the things which are, I mean, miners, even if you've got a rosy view of commodity prices, are still very speculative because there's so much natural variation. So it's not a natural holding for someone that's been very, very heavy banks. So to see that money flipping over, I think is a fantastic read on sentiment. So
I think so as well.
I might have to upgrade the clock now.
Maybe it's 6:45.
Could
now,
be.
finally, Hedley, to tie this up, this is probably our last chat for a year as I am about to go on mat leave, but November 28th is when I'm due. I want to know, what's your call for the gold price for November 28, 2026?
So on the day that you are celebrating the first birthday of another little mister, I think it's definitely going to be higher than it is now. So let me speak in US dollars. If we're 4,300 now, we're seeing gold go up between 2.5 to 3 times in this current gold bull market. And I think we could easily find ourselves at 3 to 3.5 times by that point. So move on from now. Now that would put us, I mean, one thing that I've found is really easy to jinx behavior in the gold space is by putting a price on it. So if I was to give you a range, I think somewhere between the high 4s and the low 5s is something that I would see as being, as a US dollar gold price, something that's achievable within 12 months. And I mean, the only issue I have with forecasts in gold is that when it goes up, it surprises you. So you go, oh, let's be a little bit bullish and put the price out there. You know, it could overshoot that by a long time. And I think the last time we had a discussion like this, it overshot what both of us thought by a long way as well.
We were so under last time. I think for me, it's going to be 4,800 to 5,000 flat US per ounce. So
it sounds like I'm a little bit above you there, but
you're just above me. But we will mark this right now as our final prices are in, the ranges are in, and we'll check back in on November 28 next year.
I'll send you a text to wish you a very happy birthday for young so-and-so, and we will revisit the gold price prediction then.
Sounds good. Hedley Widdup, thank you so much for joining us today. Absolutely love chatting to you from Lion Selection Group. Very excited for the next year, but I can't wait to catch up again very soon.
It's been great to talk to you, Grady, and I wish you all the very best.
Thanks so much.
I really hope you enjoyed the latest commodity catch-up with Hedley. If you did, be sure to subscribe to our YouTube channel to stay up to date with all market commentary, insights, sector discussions and exclusive interviews.